9:31 de la mañana, Massimiliano Bondurri, founder and CEO de SGMC Capital. Massimiliano, good morning.
Good morning to you.
Good inflation be temporary, actually, in the same terms that Federal Reserve and European Central Bank said 1 year ago. We could say the same temporary?
No, inflation has proven that it is not going to be temporary, and it's actually going to be with us for the next few months. If you see everything that is happening with respect to commodity prices, energy prices increasing, everybody thought that we probably had seen peak inflation about 2 months ago. That's probably unlikely to be true. And what is basically happening with respect to the Ukrainian tensions and conflicts that we're seeing, and also if you look at the Chinese situation, which is part of the country where there's lockdown because of COVID, basically all that is going to do is put additional pressure on the supply chains, which continue not working efficiently and consequently putting upward pressures on prices and production methods. Therefore, you're likely to see these inflation numbers remain elevated for the foreseeable 1 to 2 months. Then eventually we are close to the peak and we will see the actual number going down. But what is most important is for central banks, Fed especially, to be able to anchor inflation expectations rather than the actual number, because that's really what's going to be driving the change going forward.
James Bullard says 75 basis points need to be raised at the next meetings. Can we go into an economic recession?
75 it's a hike. It's probably a little bit too aggressive. We see 0.5% happening, not 75. The recession, obviously, we are running higher risk as compared to if the Fed would have started doing the tightening last year. So they've basically realized that they have been behind the curve and they have to do a little bit more, actually quite a bit more, in order to manage those inflation expectations. Clearly, the risk of a stagflations are increasing. So the recession's risk, as of now, it remains not our base case scenario. We believe the demand, especially with respect to the American consumers and the global consumers overall, remains solid and strong. Balance sheets remain strong. But that being said, risks are definitely increasing and they're not negligible. And therefore, global investors should take that into account whenever they're looking at their global asset allocation.
Looking to the European markets, what's your forecast and your concerns about European Central Bank and the global European market?
The European Central Bank is going to be trying to normalize its monetary policy as well. Clearly, it's not going to be as hawkish as the Fed, but we've seen that the bond buying is going to come to an end in just a few months, and they will try and put in a few hikes before the end of the year. So definitely, we're not in an accommodative policy anymore. There's going to be a normalization trend, and that's very likely to be weighing on the risk sentiment and global valuations. But probably that's a little bit for the following quarters, not so much now. Clearly, the risks now with respect to European valuations are more linked to the Ukrainian tensions and with respect to any positive or negative developments from those, basically from that conflict. So that's going to be the one which is really going to be potentially hitting the markets. And of course, in Europe, it's time for difficult questions and answers now with respect to the change in energy, with respect to how they're going to be changing their energy source. And don't forget the French elections coming up. So all of those are going to be weighing on the markets.
What are your primary threats of economic expansion?
In the US, definitely the tightening cycle of the Fed is one of the main threats. In Europe, we see it a little bit more linked to respect to this conflict in Ukraine. But overall, the main risk, which is true across the globe, is just these supply chains. Because if you don't get them restored to what they were, I'm not saying pre-COVID, but at least halfway there, then you're going to be seeing continued pressures on prices. You're going to be seeing continued pressures on productions overall. And that could dampen production in general and therefore could hurt growth going forward. In terms of consumption demand, we see it relatively strong. We don't think that it's going to fall off a cliff. But clearly, if you get a risk-off sentiment because of negative headlines in the risk I just said, coupled with supply chains issues, that could spell trouble for markets and therefore growth.
What do you expect about company results for this year?
This quarter is likely to have been relatively positive. So we have seen that in terms of earnings announcements, the companies that have already published have actually come with positive surprises. So we expect the quarter that just passed to be relatively positive and continue surprising positively. That means what is more important is respect to the guidance, especially in an environment like the current one where visibility is low, where there are a lot of risks and uncertainties. Guidances of the big companies, especially with respect to the big tech companies, look at the Nasdaq's corrections year to date, which is quite impressive. So guidance is really going to be key here, and there you could get a bit of a mixed bag, because you're really going to be seeing the companies that manage to pass over the additional costs and the additional inflation costs to consumers doing well, especially those that do not rely on debt. While on the other hand, highly indebted companies which maybe do not manage to pass those costs on as much, their guidance is likely to be a little bit disappointing, and that could be seen negatively from the market.
Thank you very much, Massimiliano Bondurri, founder and CEO at SGMC Capital. Good day, good business.